What is national income? National income shows the flow of goods and services in a nation over a period of time, usually a year. National income accounting have several concepts. Concept number 1, Gross Domestic Product, GDP. GDP shows a total market value of all final goods and services produced by factors of production in a country over a given period of time. Gross National Product, GNP, is a total market value of all final goods and services produced by the residents of a country during a given period of time. The difference between these two concepts, gross domestic product refers on domestic production. Gross national product refers on production-based nationality of factors. So, to get GNP, we must add GDP and net factor income from abroad. Net factor income from abroad means we need to subtract factor income received from abroad with factor income paid abroad. Concept number 2, market price, MP. Market price is the current price in the market through the forces of demand and supply. Factor cost, FC. Factor cost is the real price earned by the producer or sellers. To get GDP at factor cost, we must subtract GDP at market price with indirect tax, and then we plus with subsidies. GNP at factor cost equal GNP at market price subtract with indirect tax plus subsidies. So, in this accounting, we have a value for depreciation. Sometimes depreciation, also known as capital consumption allowance. Now we go to concept number 3, net national product, NNP. Net national product is the market value of the net output of goods and services produced by a nation in a year. So, NNP at market price equal GNP at market price subtract with depreciation value. National income at factor cost. National income at factor cost is the total of all income payments made to factors of production. So, national income equal GNP at factor cost subtract depreciation value. It also means national income equal NNP at market price plus subsidies subtract indirect taxes. Concept number 4, personal income. Personal income is the income that is actually received by individuals and households in an economy in a year. So to get personal income, we add national income with transfer payments, subtract corporate income taxes, subtract retained earnings, subtract social security contributions, and also subtract with insurance premium. Disposable personal income, it's a part of the personal income that is left after the payment of personal direct taxes. To get disposable personal income, we need to subtract personal income with personal income tax. The uses of national income. First, standard of living comparison. National income data helps us compare the standard of living of people in different countries to the people living in the same country at different times. Second, economic performance over time. National income estimates are given to measure the performance of an economy over time by comparing the national income of one time period to that of another. It tells us whether the economic performance of a nation is growing, stagnant, or declining. Third, national planning. National income statistics are a very important tool for the government to formulate its short-term and long-term economic planning. The government can also use national income statistics to forecast future developments based on current economic performance. Number 4. Sectoral contributions. There are three main sectors in the Malaysian economy. The primary sector consists of agriculture, fishing and mining. The secondary sector consists of manufacturing and construction. The tertiary sector comprises services like government services, electricity, gas and water, transport, storage and communication, and finance, insurance, real estate, and business services. National income statistics enable us to identify the important sectors that contribute towards economic growth. Number 5. Economic policy. National income estimates are the most comprehensive measures of aggregate economic activity in an economy. With national income estimates, future economic policies for development of a nation can be formulated. Number 6. Inflationary and deflationary gaps. National income data helps us to know the purchasing power of money and helps the government implement anti-inflationary or anti-deflationary measures to stabilize the value of money. Number 7. National expenditure. National income estimates show us how national expenditure is divided between consumption expenditure and investment expenditure. National income provides information for reasonable depreciation to maintain capital stock. Number 8. Public sector. National income contains the figures of consumption, savings, investment, imports and exports. These figures enable us to know the relative performance of both the public and private sectors in the economy. And lastly, number 9, Distribution of income. National income estimates show the distribution of income among different sectors and among different factors of production in the form of rent, wages, interest, and profit. Difficulties in calculating national income. The first one is problems on non-monetized sector. Problems of a non-monetized sector usually arise in most third world countries like India, Bangladesh, Myanmar, Cambodia, Vietnam, and many African countries. The existence of a large number of non-monetized activities in these countries, especially in the agriculture sector, makes the computation of the national income more difficult. Second, problems of illiteracy. A large number of small producers in third world countries are illiterate and are unable to keep accounts on their productive activities. Thus, they fail to provide accurate information to the government for purposes of calculating national income. Third, problem of expertise. The lack of professionals such as statisticians, researchers, programmers, and analysts is a major problem in third world countries. Fourth, problem of less sophisticated machinery. Another important difficulty is the non-availability of sophisticated machinery, such as advanced computers or programs to compute national income data. Number 5, problem of double counting. Double counting implies the possibility of intermediate goods being included in the national income more than once. For example, in the production of a dress, we need cotton which costs 2 ringgit. The cotton is processed to form thread which costs 4 ringgit, and these threads are woven to form cloth worth 10 ringgit. The dress is made of cloth and sells at 18 ringgit. If we calculate the price at every stage, its money value will come to 34 ringgit. But the actual increase in national income is only 18 ringgit, which is the price of a dress. The best way to avoid this problem of double counting is to calculate only the value of all final goods and services which constitute final consumption by end users. Number 6, problem of false information. People do not disclose their income or underestimate their income to avoid paying higher taxes. This will affect the calculation of the national income. And the last problem is problem of multi-occupations. People have been found to be engaged in a number of economic activities which are not included in the national income. An example is that of a full-time employer in a company who earns a fixed income and sells burgers at night. The income from the full-time job is included in the national income, but the income from the selling of burgers is not calculated in the national income.